We are live. Today is Tuesday, June 18th. Imran, this is the mid-mark of the year. This is mid-term options expiration. Big quarterly expiration. How you doing?
I'm good, man. Good to see you.
Yeah, it's great seeing you. You've been doing some more work with us and SpotGamma members, and the feedback from that has been amazing. People say it's still not as good as my webinars.
But, of course not, mate. Of course
not. but they're really enjoying that. So thank you very much.
I enjoy it as well. To be fair, that's what I started this whole options insight racket for, man. It was to teach people, show them the benefit of my experience, and it's nice to have engaged people like that asking questions and benefiting from it.
Yeah, we're super fortunate that people do engage like they do, and we actually do 2 webinars on the same day, and people will show up for both. So that's awesome, and we strive to add value over here. Hello to Kevin and Michael D'Souza. Good seeing some of you show up for our conversations here. So we have a couple of things to talk about. I was talking to you before we started this webinar that I tend to be not so organized. So look at this. I preemptively thought about what we're going to talk about today: the call heavy options expiration, correlation, and dispersion. Which now the joke on Twitter is dispersion is going to break the market. I actually think in a way maybe it already has, but we could talk about that in a moment. And then obviously Nvidia and XLK, and then kind of month end we got to touch on the infamous JP Morgan collar and just the path dependency of the way things are shaking out. Now, one thing I want to add about this before we dive in further is we never tried this before, but we produce an OPEX spreadsheet. So if you go to this link here, and I can turn on this QR code, like I said, I'm super organized for this one. There's a QR code. You can snap a picture of that. You're going to get a spreadsheet. That spreadsheet allows you to obviously, you download the spreadsheet, which explains all the biggest single stock names, all their different OPEX related attributes. So you can check those out, see what names are big for this options expiration. But then Imran and I are going to shift to a private Zoom call. Our SpotGamma members are, of course, going to be joining that Zoom call. But anyone that downloads the spreadsheet will also get access to the Zoom call. And we're going to specifically line up some trade structures that we're looking at into this big options expiration. So I'm going to leave that QR code up there. If you want to scan that, you can, or I'll bring this link up. We can put it in the notes as well. So enough of me yammering on. Let's get to the meat of it. Imran, the thing that I would take away from this options expiration is, and if I scroll down a little bit here, this is on your screen. This is the size of call deltas, which is the orange bar, versus put deltas, which is this little blue bar down at the bottom here. If you look at this, including single stocks, there's this funny Goldman number that everyone quotes in terms of trillions of dollars of, I guess it's nominal. I don't know what you quote that. They assume every one lot equals 100 shares when they do these values. But if you take that value, this is bigger than the March options expiration. March options expiration was 5.4 trillion, which just sounds kind of stupid to say, but this one is 6 trillion. So it's bigger. The other thing to note is if you measure it from a delta basis, so that's the stock equivalent, this options expiration across single stocks, ETFs, index, everything is 11-to-1 call delta to put delta, whereas March, don't forget, we were hitting all-time highs in the March OPEX, was only 5-to-1. So we are much more call bloated, I guess I would say, which I guess the word bloat infers what I think about it, in this options expiration than we were in the past. I would also want to add one more thing before I get your initial feedback. I know it's been a lot of me talking. We did a study, and we found that 68% of options expirations, on average, it flips. So if we're positive into the week of options expiration, 68% of the time we go down, or vice versa. So if we go down, we end up finishing higher. What is interesting, if you look at whether or not VIX expiration occurs before or after, the likelihood of that OPEX flip is almost 50-50. It does sort of decrement that performance, which is interesting. And obviously today was VIX expiration. So I've said a mouthful. What's your sort of initial take here before we dive into options expiration? And if you have any notes on VIX expiration, you want to drop those off before we continue?
I don't have any notes on VIX expiration.
Yep.
I would, and it's kind of done now anyway. So I think that the call delta is interesting just because it somewhat explains why this market just can't go down, right?
Yes.
Like, So as we have, if those calls are all in the money calls that people have put on ages ago, and they've gone deep in the money, well, the closer you get to expiry, like if it goes from a 90 delta to 100 delta call, and the dealers are all short those calls, then what happens when it goes from 90 delta to 100 delta? The dealer has to buy more stock, basically, right? So that Van der Charm effect that we talk about all the time is very evident when that call delta is so high. If it was call delta struck on the upside, then it would be decaying away and it would have the opposite effect.
Yeah.
Because it's call delta that's struck on the downside and it's deep in the money delta, it's not going anywhere. In fact, it's tending towards 100%. Then that is what supports the market. So I think it's going to be really hard to shake the market before Friday, based on that evidence and based on how the week has started out. It's kind of confirming that.
Yeah, and I think it's a tale of two cities, which brings us into this next topic of correlation, where I'm particularly interested in getting your feedback on this. There's this like running Twitter joke now that dispersion is going to blow up the market, and kind of like all these tweets. There's a good Odd Lots podcast that just came out about the dispersion trade, and this is not really a new phenomenon. If we look at correlation here, whether it's 1 month correlation, 3 month correlation, 6 month correlation, and this is implied, so it's forward looking in that way. We're at 2017 lows or at all time lows. And so the idea here is obviously not a lot of movement in the index side, but a lot of single stock movement, which, if you look at, for example, this chart here, Nvidia, this is as of yesterday. I think this is widened even more. Nvidia is up 40% over the last month, whereas S&P is up 2.5%, right? It's insane. And then not only that, I know the performance of this chart has flipped around a little bit here, right? But you get this tale of three cities maybe, where Qs are up 7.5 or 8% into this month alone. Spiders are up 4% on a 1 month basis, and then IWMs are down 4%, right? So there is what you're invested in the equity space is having an outsized effect. So the idea here is that in the S&P 500, we have these big call overriding programs, right? The 200 billion of AUM of derivative-linked ETFs. So there's like the JEPI, which is the biggest, which sells 1 month calls. There's the JP Morgan Collar Fund, which also sells calls on a quarterly basis. So there's that overriding, which adds a lot of positive gamma to the market and in theory really suppresses volatility. I also believe, and have seen tons of evidence, that zero DTE flow suppresses volatility. I believe it brings mean reversion to the market. So you have those flows that I think are squashing volatility. And then you have what I think is a very heavy long call bias in single stocks, particularly, the AI, the AI related names. So the question, has been, look, if you look at volatility writ large across the globe and across assets, credit, FX, et cetera, vol's been very low, right, globally. And so people say, well, that's a central bank phenomenon, not special to the S&P. But what I would say, and this chart came across, and because you sit in London, I think you have a little bit of a better view on this, certainly than I do, and maybe better than most.
This chart was in my daily report to my subs today. This chart was.
Yeah. So this is a comparison of rest of the world equity vol from Goldman versus S&P, and what you can see is that rest of the world equity vol is very high. France and Europe generally had a rough week last week, and the S&P did not give a right? Which I think backs this idea that there are unique flows here in the S&P that relate to this correlation trade and relate to the lower relative vol on the index side. Again, I've said a mouthful. I'm sure that you have a lot of thoughts on this, so I will pass the baton to you so you can.
Sure. So I mean, this spike in this relative volatility, this is the realized vol of MSCI World relative to the realized vol of S&P. That's a 5-year high. It's at. We have had a bit of turbulence last week in Europe for those who weren't watching, because they've called a snap election, and there's quite extreme outcomes potentially if you get a far left or a far right government. So the market got a bit spooked. Deep downside puts went a bit ballistic. And the funny thing is that did start to filter through to S&P as well. So whilst it didn't really move the S&P index, If you look at what happened in the VIX, VVIX caught a bid. If you look at what happened in the downside fixed strike vols, they caught quite a significant bid for what was a pretty quiet week where the market was up 1.5%, right? So you are starting to see a little sniff of tail risk hedging come in, because if I'm in Europe and I used to be a market maker in Europe, right? So I used to be in the epicenter of what is happening in that vol market right now. And if I got lifted out of a load of downside in Europe and I couldn't get my hands on any European downside, I had no other choice but to buy S&P downside, even though it was not going to help me at all, most likely, just to cover my headlines and my, what we call it, my slides, or my headline tail risk, how much I lose down to 20%, just to cover that. So my risk managers get off my back, I would have to buy a load of S&P puts. And knowing that those are going to be a waste of money, by the way, right? No one's buying S&P puts down 10, 20% thinking they're going to actually get rich on those. But unfortunately, they have to buy them, because if Europe's down 20%, they've got a massive hole in their book. So that's why they're being forced to buy them. So we did see a bit of that. We didn't see tons of it. I wouldn't be surprised if we see more of it going into the end of the month, actually going into the election. And so any calm that we have this week on the back of the Vanna charm flows holding up the single stocks, I think is giving us a little bit of an opportunity to own some downside, because I wouldn't be surprised if there's a little bit of an air pocket next week if Europe stays nervous and you haven't got this gamma holding the market here anymore. Does the S&P maybe get to, I don't know, 5,400, like 1.5% lower? Is not that challenging, right? That would be a massive drop for S&P.
I can just see all those tweets now. Back to where the S&P was last week. I hate that.
Yeah, exactly. But that's the point. I mean, we are playing for small moves on the S&P. That's the nature of the beast. On the dispersion stuff, the point I would make there is it would be useful to see a realized correlation number, because whilst the implied correlation is at the 2017 lows, my belief, and I haven't seen the number, but I'm pretty sure I'm right, is that realized correlation is massively low, right? As in, and the reason being is, 5 years ago, the biggest stocks in the index were not stocks like Nvidia that were moving on a 50 volt, basically, right? And you weren't in this weird space where the biggest names had this massive like retail army. Maybe it's not just retail, right? Insto as well, who were just more than happy to just buy your amount of vol on this thing, and the moves were being delivered. Facebook, every time we have earnings season, mega cap tech companies that are like in the 2-3 trillion market cap are moving 20% on earnings. It's insane. You never used to get that on the biggest stocks in the S&P, but now
not even on earnings. I mean, this was just a little product announcement, right? For Apple.
Yeah, that wasn't even earnings, and it had a big move on earnings, but it was I wouldn't say it was a little product announcement. It was a big conference that they had, that they were building into, that they, there was hype about this conference, right? And then the fact that the products weren't that mind blowing that they announced, that we were joking about it on Twitter. Yeah. But then I think when Wall Street embraced it and said, it doesn't matter that it's not a new innovation. If anyone in the Apple ecosystem wants AI features, they're all going to have to upgrade their devices. And that means Apple's going to make shitloads of money because we've got an upgrade cycle, right? That's what Wall Street cottoned onto. And that's why the stock had that little dip to 190 and then roofed it to 215. Because everyone was like, okay, yeah, you're right. They haven't innovated that much compared to everyone else, but they've got this captive ecosystem of Apple that the whole planet's on. And if they want these features, which they probably do, they have to upgrade their devices, right? So that was kind of what happened there.
But to your original point, though, this is not a small market cap company, right? That's a lot of dollars gained and lost, right? I mean, the GDP of some countries gained and lost on the AI announcement, right? It's pretty mind blowing if you really think about it.
It is, I agree. But then also it's mind blowing that the national debt has increased by 11 trillion in the last 4 years. That's quite mind blowing as well.
Yes, money. What is money anymore?
Exactly.
Money is a deep fake. I guess
we're just adding 3 zeros every sort of few years to everything, right? It's just yeah. That's why I'm long Bitcoin. To digress.
Yeah. We posted actually a chart. Sorry for all the noise on that chart. We posted a chart that Bitcoin's struggling a little bit here. That wasn't on my docket of things to talk about. But if you want to take the baton on that one, S&P.
I think Bitcoin. Look, the day-to-day swings of Bitcoin are quite hard to really rationalize, right? I think with Bitcoin, you just need to zoom out, right? If you zoom out, it's the best performing asset that ever existed, right? And it's in a consolidation phase. It's waiting for the next breakout above 72K. When that happens, we're going straight to 80. Maybe we're going straight to 100. Who knows?
Yeah.
But when you zoom out, there's just no question of what the direction of this thing is, right?
Yeah.
That doesn't mean it can't halve tomorrow for some reason. It can. But everyone who believes in it and understands the story is going to be if they haven't over-levered themselves and they haven't blown up their accounts, they're going to be buyers of dips, basically, right? So it's just, that is the story. I essentially think this is the inverse of the debt story, right? Like every country, every fiat currency has to be debased, trillions and trillions of dollars of debt that are never coming back, right? And it's just the reverse of that. So if you want something that protects you from that exponential trend in debt across the world, then I think your only real protection for that is Bitcoin. Now, if Bitcoin has a problem in terms of the blockchain gets hacked or there's some quantum computer that cracks it or something, of course, you'll lose your money. So you don't put your entire wealth into something like Bitcoin. But I'm a strong believer, which is why I've got this top on Deribix. That's where I trade my crypto options. I'm a strong believer that this is something that every investor has to have in their portfolio in some shape or size, because it protects them against that ongoing fiat currency debasement that we will never escape from. Basically.
Right. Yeah. I do agree with that. I think most people listening here would. And whether you choose gold and some Bitcoin and stocks, right? I mean, there's that right tail issue, I think, in stocks and just assets generally that, I think we could all agree on one thing, that politicians aren't really, whether you're left or right here in the US, you can say that no one here is really willing to tackle the debt issue in any material way. And so, we got that right tail issue, I think, for sure over the long term. I wanted to pivot back just a little bit here to the equity space. So you're seeing a little breakdown. The reason I brought up Bitcoin is we did a study very recently that showed that positive forward returns of Bitcoin had a very strong link to positive forward returns in the S&P as well. So basically, Bitcoin, you could think of it actually move a little bit faster than the S&P. And so the fact that we're down a little bit here suggests that, statistically speaking, we could see a little bit of weakness here in the S&P. And so I just want to round this out about the dynamic here in the positive gamma space. Right now, if you look at it, we have a ton of positions, sticking right here, 5450. I keep forgetting what number we're on because we keep going up so fast. 5450-ish, right? You can see this huge call wall, we call it here, but 5500. We're really pinned in that area, and we're going to lose about a third of the S&P gamma, which should decrease this positive. We're going to remove about 50%. Let me restart here. We're going to remove about 33% of the positive gamma in the market, which should allow volatility to pick up a little bit. And so when I'm looking at these key levels that could come into play, you mentioned 5,400. That's clearly a major level. You can see it right here. And I actually think we have positive gamma support even down to 5,300. And I would expect any dip that sort of shows support above 5,300 is you kind of want to start to buy that and look into the year end, look into month end. It's a viable dip opportunity. The point where I would be stopped out of that trade and just want to go short was way down under 5,300, where I think the dynamics change. And the reason is because there's a bunch of long put holders at 5,300, and I think that volatility could really pick up materially in the S&P in that case. So my kind of question to you about this is, if you remember in April, I want to zoom back a little bit on this. And this is going to be a little bit of a transition to Nvidia and wrapping the correlation. This is that in April here, right, we went into the end of March and we saw about a 5.5% drawdown in the S&P 500. Pretty strong drawdown, right? Nvidia over that same period was down 20%. So, yes, we've had this incredible move up in Nvidia in some of these individual single stocks. But if we start to get a little bit of a drawdown, OPEX induced in particular, considering that there's probably a lot of negative gamma in the single stock space, if we start to unwind some of that, how do you think about playing some weakness? I know you mentioned that you're in some put spreads and stuff. If you do believe that there's OPEX induced weakness coming up here, do you focus more on single stocks because of that, or do you start to look at the index side a little more?
I would do a blend of it, to be honest, because you don't know, right? I agree. Like the semis are just on fire. They're insanely overbought, right? Nvidia, but all the other semis. I mean, Broadcom's been since earnings. Broadcom's at like 1800. It's unbelievable. So I feel that these are overbought, but they're dangerous to short these names, right?
Yes.
So the only way you can really fade them is via put spreads because they trade on a high vol. You don't just want to buy a load of like puts on a 50 vol and bleed like crazy while you wait. So put spreads enable you to have a sensible bleed, give you some leverage to the downside, some monetizability if it comes off. I think they give you that decent blend. So some sort of end of June to mid-July type put spreads in names like Nvidia, I think look okay. I've got some of those on, but I put them on a bit early before it got to 130. So I might fire a second bullet though. With a lot of these trades, it kind of makes sense to tranche it a little bit. Something me and Matt discussed in one of the SpotGamma webinars that we do for clients. So I might fire a second tranche at the end of the week if Nvidia is still chilling up here for a July put spread, something like that, basically. Yeah.
We're gonna.
Sorry. Yeah, just other names like Microsoft as well. They're probably a bit safer to sell calls on. But if you own Microsoft, I kind of think owning bearish risk reversals on Microsoft looks like a bit of a no-brainer right now.
Yeah, and we'll be talking about some of this in a little bit more depth, specifically at the OPEX trading webinar. Again, you can scan the QR code at the top left, and we'll be having a direct link to that momentarily. But I don't know if this is true, but our friend Dead Cat Bounce, we all like the Dead Cat Bounce zero hedge reports. Nvidia's now surpassed Apple and Microsoft, so that's
going to trigger a rebalance apparently in XLKs, right? So you're going to get more Nvidia buying into the end of the week as there's this massive rebalance, right? So that might fuel Nvidia to go to some stupid number like 150 by the end of the week.
Yeah. So what's interesting about that is that story's been out for a little bit, and so what I wanted to talk specifically on that topic, as you can see, I have here, is that XLK is $67 billion. That's probably higher than that now because that stat is a week old. So maybe it's at $100 billion. I don't know. And so Apple right now, I think, is 11% of that ETF, and Nvidia is 6%. And so that would have to be reweighted potentially, where Nvidia would have to go up to 11. And I think that roughly equates to something like $11 billion worth of Apple, negative flow for Apple and positive flow for Nvidia. I wanted to bring up some other stats about Nvidia because, I mean, it's one of the most interesting things that we can talk about at this moment. A couple of things that I think are interesting here. Number one is this chart here, and if you can't see it, let me try to bring this up, make it a little bit bigger for everybody here. What I did here is I went back and I looked at what I call the raw call delta. So I couldn't estimate, hey, this was bought or sold. This is just the total amount of calls on a delta basis, right? And what you see here in pink is Nvidia. And then what you see here in this aquamarine color is the spiders. And so the Nvidia call deltas now have surpassed SPY deltas, which is really pretty incredible to think about. This way up here is QQQ deltas. And then up here is Apple, Google, Microsoft, the other mega caps. So the amount of call flow and the size of call positions in Nvidia is insane. The only time we've seen anything like this in recent history is with Tesla. And if you remember how crazy Tesla was in 2021, you could see that dark green. And I apologize to everybody for the color schemes here, but this is Tesla here. And you remember Tesla split and then it went into the S&P 500 and everyone was losing their minds getting in front of that trade. And it peaked in November of 2021 and sold off. And so I don't want to say that I'm calling an all-time high in Nvidia. I'm not trying to do that.
Brave man who does that.
No, but what I am trying to say is this situation where it outperforms the spiders in the broader market by 40% a month every month, I think that I'm sticking a fork in that one, right? That relative outperformance, I think, is due. And I don't know that is that incredible of a statement. I just think that Nvidia is such a momentum trade when you look at the huge call complex, these leveraged ETFs, the fact that it's 25% of the SMH and 6-7% of the Qs and 6 or 7% of the S&P. And so it's like all dollars that go into the market asymmetrically go into Nvidia, and you have this clearly long short gamma complex in Nvidia that is really spooling this thing. I would also add, if you look at open interest right now, so if you download that spreadsheet that's linked, you will see that Nvidia open interest is 38 million contracts as of 2 days ago. The next highest on that list is the SPX, which has 23 million contracts. So the number of contracts in Nvidia is way larger now than the S&P 500, which is crazy. Not only that, if you look at the call volume, Nvidia has the most call volume for the month of June, heavily outweighing even the closest competitor or the closest, nearest ETF or equity. So Nvidia, from an options perspective now, from a total notional value, it's still not the SPX index, right? Because the SPX still has that larger notional value
on
of
the
complex
contract.
store.
On the contracts thing, did that go up by 10 on the stock split as well?
What's interesting about that is that the volume, and I looked up on Bloomberg about this, so I pulled a couple of different sources, about this. So that is adjusted for the split, the open interest, and so that could have played some of the shifted some of that total contract value, and so there's a little bit of shenanigans maybe there. But if you look at volume, actually, the volume this past week after the split went down, which I thought was interesting because you would have thought that there would have been this real retail bid, and maybe there is because the stock is up so much this week. But the idea was like, hey, the stock is now 1/10 the price, so retail can jump in and options activity should increase. But what this all says to me is it's extremely bloated. Like, we're just way over our skis here. And what I keep thinking about is that April period where the S&P went down, every day. It was a pretty controlled descent, but there was a really violent move lower in Nvidia. And to that point, this is a regression plot where you can see this is the relationship between Nvidia and S&P over 5 years. And it's pretty linear, as you can see by that black line. But in April, we had this big negative X, right? I think this was one of the worst one-day returns in Nvidia, where the S&P hardly did anything. And so you can see that the relationship here is flattening out. Nvidia is becoming more and more decoupled, I guess, from the index itself. And I think that it's really just hitting these extremes. Here is open interest that you asked. Open interest in purple is from Bloomberg. This is the call open interest in yellow. So you can see there was this weird bump down, right, because of the split. But it appears even kind of before this rally that open interest was tailing off a little bit. So it is tailed off, but it's still the largest. And then in blue and red here is the volume. The volume really dropped rather significantly. And the stock volume seems to have, come down a little bit as well. So, and I know, there's some split maybe noise involved in that, but, that's the current state of affairs. The last thing before I get your kind of Nvidia specific, downloading thing you want to add, I normalized volatility here, 10-day realized volatility. I know you like to look at shorter dated volatility or shorter term volatility. And you can see that volatility in the S&P 500, which is orange, versus Nvidia in yellow, they generally rhyme, right? There's some earnings noise in Nvidia that you don't get in SPX. But in the last couple of months, there's just been these bouts of volatility. It's like the way that I picture it is like, when the wheel starts to oscillate when it's coming off of a car and it starts to move kind of faster. That feels like what's happening with these rolling spurts of volatility. So that's my Nvidia in a nutshell. I would love your general. Again, I know I said a lot, but what do you?
Yeah, I mean, the thing about Nvidia is, it has had ridiculous earnings. It's had ridiculous performance, but it has had ridiculous earnings growth as well, right? So a lot of it was justified. So we look at it, as traders, we look at it and we're like, what the hell is this parabolic? It's ridiculous. It's a bubble, blah, blah, blah. But if you look at the earnings, that's a bubble. That's parabolic as well. So I think the thing about Nvidia is because they were so far ahead of everyone else, they basically had all the market share, and now everyone's cottoned on that this is the future. This is the demand. Everyone wants to be in AI. Everyone wants to develop all these amazing AI features and products and stuff. So Nvidia's got a load of competition coming down the pipe, right? So, but it's just a question of how long will it take the other companies to not need Nvidia? So you have Tesla announcing, or Twitter AI announcing that they want a load of chips or whatever, right? And suddenly Nvidia goes again because it's just like, okay, we'll have as many chips as you can give us, and it just goes off the shelves, and they literally can't make them fast enough. So I don't know how long that period of time is until people like Google, Microsoft, whoever, Amazon, who are all building out their own chips so they can be their own suppliers. At some point, Nvidia's going to run out, as in it will always have some demand. It will always have clients. But what I'm saying is this this state of the world where Nvidia's just miles above everyone else isn't going to last forever. And yeah, clearly you've had some artificial buying from like generally into stock splits. You get a bit of crazy buying, and here in this rebalance, here again, if the reason we're going to get outperformance this week is because people are kind of forced buyers for the rebalance, that's not necessarily a fundamental reason to buy the stock.
It's
right?
a positional, right?
Yeah. So fading those things in for a near-term pullback, I can get on board with for sure. But no one's claiming that this stock has topped, right? Like we don't know where the ultimate top is in this stock.
Yes.
And therefore it could. Yeah, I mean the stock's at nearly at 150, 135, but I say 150 because I'm expecting it to be there by the end of the week at this rate. But yeah, the stock may not top until well above 200-300, God knows, right? So I wouldn't be shorting this name. I wouldn't be selling calls in this name. But I think put spreads look sensible, and I think I'm going to fire probably another put spread out in July towards the end of this week.
Yeah, and your point is well taken, and I'm with you. I don't know when the revenue tops out, or excuse me, when the outperformance or stock generally speaking tops out. I just think again this Nvidia up 40% a month each month versus a more laggy S&P. Just at some point that's got to come in. Now I know, and I'm probably going to get a bunch of nasty tweets about this, but I was just pulled up the annual revenue just quickly. Apple's annual revenue, and granted, this is not net or whatever a metric, but it just kind of puts the size of the companies, I think, in some sort of decent term. But annual revenue for Apple, $383 billion, Microsoft, $211 billion, Amazon, $575 billion. Annual revenue for Nvidia, and I don't know when this was last updated, so I probably shouldn't even be saying this, but again, it puts some stuff in context. Annual revenue for Nvidia is $60 billion, right? So you compare that $60 billion versus $380 billion, and I understand that yes, of course, like how much are you actually keeping? The point is Nvidia is still a lot smaller than these other companies, even though the market caps are now equivalent, right? If not, Nvidia is maybe even bigger. So I think that is really saying something, and also suggesting that, hey, like you can have a very successful company with leaps in revenue, obviously, as it's been happening, but still outperform, right? Outperform even, I think, the rosiest of guidance at this point. So I don't know. We'll see. There's probably a bunch of fundamental people sitting around, waving a pen at their screen over this whole conversation. But I can say definitively that, the rush into the options complex to me just seems to be crazy, right? I just think it's so call heavy that that everybody is chasing this thing. And there's probably some performance anxiety related to that. Simply saying that, look, if I am running money and I'm just invested in the Qs or the spiders, are you getting phone calls saying, hey, Nvidia's up 40% this month and you have me in the Qs and you only made me 7%. What are you doing? So you just have to go buy more. I don't know. S here says, to be fair, Nvidia revenue is only $60 billion now, but the potential for it to reach $1 trillion, right? And I think that's the kind of thing. It's like, the forward guidance on this thing is essentially at this moment unlimited, and maybe that's fair. I think we all believe in AI. I would assume that if Nvidia is making this much money, other companies are going to want to get in on that. Maybe there's just such a big moat they can't, and so it is what it is. But
exactly. I mean, but we as sort of more tactical traders in the options space, we try to find these opportunities to kind of play the swings a bit, right? And this swing looks very blow off toppy, basically, right? It looks very exhausted here, just in terms of how extreme it's been. But the problem is you never know when the end of this type of move is. Like, does it end here? Does it end at 160? Right? That's still another, God knows, like 20%. So it's very tricky to play these, which is why I think optionality is your only way to play them.
Yeah. All right, now moving on here, we got another about 10 minutes because you and I have to transition over to the Zoom call. Again, if you're looking for that link, you can click the QR code, get our OPEX spreadsheet, pull up the link on your screen here, and Imran and I will be talking about specific trades that we like. I know Imran kind of gave a little bit of hint of some of the things he's looking at, but we'll talk about that spreadsheet, some specific trade ideas that we like. I wanted to finally talk about just what our kind of projections are here for the end of the month. So the volatility environment, as you mentioned, vol caught a little bit of a bid after the French election scenario, and I was looking at skew here on screen, and this is comparing about a month ago. We saw. Make sure I got the S&P up. We saw vols increase. So this is mid-June in gray. On a delta basis, we're looking here versus today's skew. And what you can indeed see here is that vols are higher than a week ago. And I do think that around the French elections, or not the French elections, well, I guess it's French election headlines, we saw a little bit of a bid to vol, and you could see that vol did increase. And the VIX is fairly sticky here at 12.5, right? Realized vol in the S&P is at 8%, 8.5%, somewhere down there. So realized vol is really quite low. And so I think that this is a situation where we're going to go into OPEX. We're going to get some volatility, downside volatility, but I think any bump in vol gets squashed. And then we start to see sub 12 VIX. We see that 1 month correlation break lows, and we start to really own this 2017 style, lows and volatility in front of an election. So, said another way, I'm looking for some weakness next week. I expect that equity dip gets bought, any pop and vol gets sold, and then we kind of rally into the end of the month.
Do you think? Do you think 5,500 is the pin for OPEX though? Do you think we struggle to shake that?
I think we're in what I would just call the pin zone already. I mean, in the chart that we just showed here, right, we can see where the big strikes are. 5,500 is a giant gamma strike. And then there's a whole bunch at 5450 in the SPX. There's a ton of positions at Spider 545, sorry. And so we're just thick with all these positions up here. So if we drift another 15, 20 handles up or drift a little bit down.
Have you got that chart? Can you show that chart for NASDAQ? Is there any big strikes on NASDAQ?
Yeah. So bring that one up for you here. And you can see right there is, sorry, we loaded this up. So there's 480, and you can see there's a lot more contracts up at 490 and then even up into 500. And so you kind of just sold my last piece for me here. I think we're so close to this 500 QQQ thing now that seems like almost an inevitability off of a little bit of weakness, meaning we pull back a little bit and then hit a final shade higher. So what's interesting about this is that we could get a little bit of a pullback, and then in about 2 weeks we have obviously the infamous JP Morgan collar trade come up, and that strike's sitting up at 55.50. How do you lay out the next kind of week? So again, I'm looking for an equity pullback, little vol pop that gets squashed, and then we rally to more new highs into July. What's your sort of thesis here as we look forward?
Yeah. So in general, I thought the market was trading like it was long gamma. And I thought, that gamma probably increases into OPEX. So normally what you see, if you're trading like your long gamma, in other words, realized vol is low, implieds are getting offered, you wouldn't really see the sort of price action that you saw this week, right? You wouldn't see market ripping up 1% after the weekend and then implied vol catching a bid. And so there's two drivers of that in my view, right? One is the stuff that's going on with the French political uncertainty, right? And then there may also be a little bit of this, because these tech stocks are just like melting up. It might be that this NASDAQ open interest on the upside and stuff is not long open interest. It might actually be short open interest, right? Because you saw NASDAQ rally and NASDAQ vol, the Vixen, was going up with spot. So I'm not sure that the street is as long as they were when we were down at 5,400, because I'm not seeing the price action in fixed strike vol on the way up to confirm that. What I would like to see is really small moves of 50 basis points or less in spot, and implied vol continuing to sell off into Juneteenth. We've got an extra holiday this week, and yet implied vols are bid. Normally when you've got a holiday, implied vols are offered. So to me, I'm starting to smell that there's some instability here, because the street suddenly lost the gamma that it was supposed to have, and the market's just like shifting higher, and all these strikes have shifted higher. But I'm not as convinced that the street is long all this stuff. Now, the JP Morgan collar trade, we know the street is long. So once we get past Friday, and if we find ourselves up at near 55.25 or above, then that gamma up there is probably long gamma. and probably caps the market a little bit, right? But I'm not sure like that we hold. Like I feel like it's been more volatile than it should have been this week, and that concerns me. And the fact that Nvidia is trading at 135, and if the rebalance is going to make it go to 150 by Friday, which is another 10%, what's that going to do to the S&P? So these are the things that kind of concern me for like a pinning scenario that I thought we were going to get, but I'm not as convinced now. And then to your point, I agree that market needs to come off. And maybe it doesn't come off until after Friday because you've got all these massive call deltas supporting it, and then maybe we get a pullback. And I also agree with you that any pullback gets bought. I think we might get weakness. I think the weakness might linger a little bit longer than a week, though. So we might need to work through some weakness. Like one of my close friends who does a lot of cycle analysis, which is I'm finding quite a lot of help. Is quite helpful to navigate markets. Some of his cycle analysis suggests that we dip into June, we maybe then bounce in July, and then we see another dip into early August. And that becomes the last dip where you want to fill your boots for an election rally, basically, right? Where we rally into year end. So we might have a bit of chop throughout the summer. And I'll be trying to be in a position to be able to buy that dip to play along into the elections or after the elections.
You bring up a bunch of interesting points there. I would just say, in respect to the S&P volatility, we were up 70 bips yesterday. Other than that, though, the daily movements have been pretty tight. In the S&P, in the Qs, it's been a different story. I 100% agree, and obviously in the single stock space, it's been weird. Before I forget to ask you, one of the things on the fixed strike vol, which is a little weird, and I couldn't pick up a clear reason, why, but here's fixed strike vol in the Qs, and you could see that for Thursday we're very low, and then there's a little bit of a bid. There's this little bit of a kink for Friday. Is that, and there's not really a clear news element to me. Do you know why? Is that just a holiday function?
It might be the rebalance. It might be the rebalances, right? Because those names are such big weightings in the Nasdaq that if there's a load of
and the S&P.
Yeah, but they're bigger in the Nasdaq, right? So maybe that's what it is.
Yeah. So you see the kink in both places, which is a little bit curious, and I figured it was kind of, let's just call it positional, because there's not clear news here, and you can see that after that, implied vol is really rather low, and then if you zoom way out, you can see there's we lift due to the aforementioned elections, and I think when you look out in time. We've been unable to spark any kind of volatility. So, I think dips writ large will get bought. And I don't know why the election would be a bearish event in either case. I mean, either we stick with the incumbent who, we're at all-time highs now because of that, or we get Trump. And I think everyone would think that the market would probably move higher if we had Trump, if I had to guess, right? I mean, remember, all he could ever do was talk about how well the stock market was doing when he was, the president. So I don't know, it's not the situation like in France where it's like, right-wing socialists or whatever is going on over there. I know nothing about French politics, so I'm not offering something. But clearly the market didn't like that. Whereas, Trump versus Biden, I don't think stocks care writ large, various sectors, whatever. But anyways.
Yeah. Well, but one thing I would say on the election, though, is like the VIX kink that you have for the election is pricing in the election at about 3.25% event risk, something like that, basically, right? So it's like saying normally they price some sort of gap for the election, right? I think that is the lower end of where that gap's going to trade. Like I've seen that gap trade up to 5-6% or whatever, right? So I think the premium on VIX futures for October has room to get bigger as we get closer to the election. And I also think there's a chance that November VIX can trade at a bigger premium than it currently does. Because if you look back at when Trump was, not Trump, with the 2020 election, right? Biden versus Trump, round one, right? That, because Trump was banging on about contesting the election and it's
that's right,
and all this stuff, people weren't sure that on the day of the election we were actually going to have a result, basically, right?
Right.
So people were like, this is going to linger on for another month of uncertainty. And the way the vol market priced that was by jacking up the November VIX futures, and October started to come down and November went up and became the event bucket. So I think people who haven't traded VIX for very long won't be aware of that sort of dynamic. but I think that is quite a nice kind of tale to have in your book, that November might suddenly catch up to October in the VIX. And so I've started like looking at call spreads in November VIX as a way of just sort of owning that scenario.
I don't think that's a bad idea at all. I do think, to your point, there's a bid to vol, and you can see that, lightly in the term structure. And I think that only sort of strengthens as we get closer to the event and the news picks up and people kind of focus on it more. Which is why I think the 2017 scenario may come into play here, because there shouldn't be any major policy shifts, right? And unless we get some kind of crazy hot CPI readings and some sort of imminent rate threat, then people are going to be looking at the election. It's the summertime, and we're just going to keep on keeping on. I think in terms of the flows that we're getting, which is correlation goes down and single stocks, thematically continue to rip. So, yeah, I think we're by and large on the same page here in terms of what we look at going forward, which is again maybe a little bit of a dip here, but I think you and I both think higher into the end of the summer is the way that's shaping up.
Mm-hmm.
All right, Imran, we're going to wrap it up a little bit early today because we're going to go shift over to the Zoom channel where we're going to talk about specific trade structures. Again, if you're interested in joining that conversation, you can scan the QR code at the top of your screen, or you can go to the link that is in the Trading OPEX webinar. Paul Ingalls mentions that the JP Morgan collar is 55.70, but who's counting? 55.70. Maybe Nvidia will hit 55.70 by the time my friend is there. So thank you, Paul, for correcting me. I think it said 57.50, and then our friend JT mentioned the Apple weighting, or the XLK weighting goes from 6% to 20% or something like that. So it is a big rating again on a shift on a $67 billion fund, but everybody knows it's coming, kind of like an index rebalance, right? So it remains to be seen how much of an impact that will have. Regardless, it should be a pretty fascinating. Should be fascinating trading activity from Thursday, Friday into early next week. So Imran, while we wrap it up here, how can people get a hold of you? You do a lot of great stuff on Twitter and the like, so shoot us some details.
So on X, I am options_insight. We throw all kinds of stuff on there from our content. I've got various things going on. I've got a crypto podcast for those who are interested in the crypto story and trading crypto options. And we've also got our website where we provide research on a daily and weekly basis across all markets. So come and learn how to trade options.
Awesome. You can reach me at SpotGamma on Twitter. This conversation, if you're watching on Twitter, you can catch it on YouTube as well. I probably just got doxxed for saying YouTube on Twitter, but that's okay. That's the way it goes. And we'll see everyone in about 10 minutes on the Zoom call. So look forward to that.